Hi, this is Michael Carlin, president of Henry and Horn Wealth Management with your Manage the Funds podcast. Today, we are going to do our third quarter market outlook, and we are joined by Joe Tiber of Tiber Kosmala. Joe, I can't thank you enough for squeezing us in today. I appreciate it very, very much. I know you got a real busy calendar, so I'm hoping for the first time in quarterly market outlook history, if we could do this in 30 minutes, it would not only be a miracle, but it would be I know, amazing for your schedule too. So let's see if we can make that happen.
I am on board and happy to join you as always, Michael.
Thank you. All right, so let's just jump right into it. So this economic expansion that we've seen that started in March of 2009 has now eclipsed the market expansion, the economic expansion that ended in March of 2001 with the dot-com bubble bursting. We've had that 121 months. As soon as we crossed that, it's the longest economic expansion since 1945. We've talked about this before in the fact that, and we're going to spend a little bit of time on this, that despite the fact that this is in terms of length the longest economic expansion, it hasn't been the most robust growth of any economic expansion we've seen. It's been pretty good from that standpoint in terms of how much growth we've seen, but it hasn't been as explosive as, say, the one that ended in 2001, the dot-com bubble bursting, or the one that ended in 1969, or the one that ended in 1990, or even 1953 for that matter. So, Joe, we all kind of wonder how much gas we have left in the tank, proverbially speaking, about this economic expansion. What's your take?
Well, that's the crystal ball question. And I mean, our baseline read here is that there's still a little room to go. And that's largely contingent on what we think are just some very friendly, accommodative monetary and fiscal policies, not just here in the U.S. that are taking shape, but also globally.
I did see a really interesting slide, Joe, that I wanted to talk about. It's the Breaking the Long-Term Trend slide. And again, anybody in the audience, and you guys do a great job, email us at info@hh-wm.com for a copy of the slide deck. It's called Breaking the Long-Term Trend. And what it shows is that if you go back to 1966 and move forward all the way to present, and it has like a red line that shows if the U.S. economy were to grow at 3.1%, how much our economy in terms of size would be, and in terms of how long this economic expansion would be, and how large our economy would be. But you can see that as soon as we had the financial crisis in 2008, the economic recovery that we had, which we know hasn't been as robust as other economic recoveries, has left a $3 trillion gap in terms of where we are now in our total GDP size versus where we would like to be if we met historical standards. But that $3 trillion gap translates into $23,000 per U.S. household. And to me, I look at that, Joe, and I say, you know what? Maybe this has part of the reason locked in it why there's some angst with U.S. consumers, U.S. voters.
So breaking the long-term trend, the gap between 3.1% GDP growth and what we actually experienced, the $3 trillion gap. Two things on that. One, I think partly the slide refers to the wealth gap, and the wealth gap, as I guess in political parlance, I would categorize more as income inequality. The percentage of income being earned by the top, say 1% or top 10% relative to the rest. That's I think the political hot button that's out there a lot in the press right now. I think this chart, and that's certainly there and tangible and real. The chart, however, I think refers to the overall GDP, the lack of historical trend GDP growth since 2008. And Michael, I guess how I'd frame that is a bit more of a silver lining, only because how we see that is working off the debt super cycle that occurred ending in 2008. It took 10 years for us to work off, particularly the consumer side of an over-leveraged economy, specifically obviously on the housing and mortgage side. But it took a decade plus, which, by the way, a lot of our research houses were calling for a protracted period of underwhelming growth as we work off that that debt overhang. To today, we're looking at that and potentially as an opportunity, because what that results in is an underinvestment in cyclical spending for a long period of time. Another way of saying pent up demand. So as we look forward with regard to this GDP gap that we have here, I think we can make a pretty strong argument that we have very aged capital stock, and that's things like factories and certainly homes. The average age of the home is 5 years longer now than what it was in 2006. So there's kind of an upside to this gap in GDP growth. And then the, I guess, less fortunate downside or reality of the wealth gap that's happened because of that. But hopefully that gives you a little bit of guidance.
Yeah, it does, and I do see the same things that you're seeing. And you mentioned briefly about residential real estate, which is just not recovered. We haven't built the homes that we needed to build. But yet at the same time, we have really nice balance because the job market's so strong and the consumer is feeling pretty good, which gets me into some of the other data about how the consumer is, with the consumer confidence measures, albeit not as high as they were recently when they peaked, but still very high. Unemployment rate is about as great as you could possibly see since really the 60s. So this has been an incredible run for the consumer in the fact that they're working. This is great, in terms of the fact that they have jobs. And then you throw in the fact that wages have been particularly good too. So with wages, with the job market being strong, to us, the consumer looks good here. Are you seeing the same thing?
Yeah, absolutely. We'd concur. I mean, unemployment, confidence, and wages are the three things that we really do key in on. Wages are beginning to percolate. In fact, wages are one of the most commonly cited cost pressures currently happening in second quarter earnings calls with company management. So wage gains, now that we're over 3%, the most recent was about 3.1%, but nearer term, i.e. the last several months, you're seeing numbers closer to 3.5 to 3.8%. So wage gains is something that everybody's been waiting on. It's finally, we think, beginning to take shape. And that's really evidenced by just last week. In fact, the retail sales number came out for June, and it was much stronger than expected. Right. That's on the back of a decent April and May. So we're seeing some positive signs, certainly people spending money in the consumer health.
And if you look, we got the post-tax reform, how and when the income growth started to surge. And the income growth is the fastest it's been since the market corrected in March of 2009. And you can point to when the tax cut was enacted to when average hourly earnings surged, which was great. In 2018, I don't think a lot of people knew, but the bottom 10% of income earners had their fastest income growth ever. So this isn't a political market outlook. That's a whole different thing. So we're not going to talk about the way that Trump, delivers his message, but there is something in here, and there is something to be said about what the tax cut did and provided for wages and how the poorest income earners are benefiting in this economic surge that we're having right now.
Absolutely, a point in time, and everybody I think knows that small and medium-sized businesses were very, very significant benefactors of the tax cuts, and that did certainly bleed through into average hourly earnings and the lower thresholds of the income earners, benefiting indirectly as well. So very, very much a good thing.
And it's something else that was a good thing, I think, and I just think it's getting lost. I don't see it anywhere on the headlines, is what, we talked about the tax reform a little bit, but let's get specific about repatriating foreign dollars, repatriating U.S. dollars that were sitting in foreign bank accounts and bringing the money back from overseas to here. And the latest data that I've seen shows that about half of all the cash that was sitting overseas that corporations left there, they didn't want to bring it back here because they didn't want to pay U.S. tax rates, did bring half that money back and paid the reduced U.S. tax rates, which was a great kind of short-term tax revenue base for the government, which is terrific. And I think it bears mentioning. So it was what $900 billion is what we saw in 5 quarters coming back to U.S. soil. And if you look at the S&P 500 companies, what their plans were with all that money, the $900 billion, what they brought back, they did the following. They increased dividends and did share buybacks. They paid down debt. They did mergers and acquisitions. They bought other companies. They were helping with their own U.S. liquidity. Johnson & Johnson and Walmart are a few of those that were helping with their own liquidity in investing in their business in CapEx, capital expenditures, capital spending. Pfizer, Pepsi, Caterpillar, Noble Energy. There were many that took that money from overseas, brought it back, and did all the right things. So we're seeing a little bit of a multiplier effect. It appears as though from what happened in 2018, and we're seeing and reaping some of those benefits this year, but with all that financial activity, I just thought there would be more growth. If you're bringing $900 billion back and doing all these great things, Joe, how come I'm not seeing more growth? How come? Because shouldn't this be the 4% number? Shouldn't this be that's a lot of money?
Well, good question, and I think the answer is this. The answer is that, and you know this full well, Michael. 2/3 of the U.S. economy is the consumer,
right?
And while this bodes really well for capital expenditures and the stock market, I mean, dividends, debt pay down, and M&A, you're seeing the growth in the stock market. We're up 20%, for the first 6.5 months, roughly. Which does not happen often. In fact, it hasn't happened since 1995. So I think this played very much into financial market gains, and hopefully business spending and CapEx ticks up a little bit more than what it has. But GDP growth, quite a direct corollary there, I guess.
Yeah, and you're right. I mean, it certainly seems to be, I guess, to your point, a stock market correlation, but maybe not so much. We're not seeing it flow through to the U.S. GDP numbers, and so I do want to turn a little bit of attention towards. Well, let's do global PMI, because we're having this this kind of great renaissance with the stock market having the kind of year that it hasn't had in a long time. It's been a great 6-month, 7-month run, really. We're going to talk about whether or not that's going to continue here soon. And I'm looking at things like, the global manufacturing PMI, or essentially what the globe is putting out. Is the globe growing or is the globe shrinking economically? And global PMI has been falling down a cliff, really 2018 and through today, where we finally got a negative contracting number on global PMI. So it's been a little bit of a different story where we're having a renaissance here in the U.S. stock market, where we have a lot of good economic factors that are working for us with the jobs and wages, as we've mentioned. But you've got this global PMI with this downward trend that gave us a contractionary reading. How worried, even though you and I were constructive on the market, but how worried do you feel or believe that global contracting PMI is?
Yeah. Concerned for sure. PMI, Purchasing Managers Index, for those of you on the call, is a really good read on global manufacturing activity. And like Michael said, absolutely has fallen off a cliff, both in Europe, Asia, and now finally the U.S. has followed suit. The U.S. in fact dropped from the low 60s. And by the way, anything in excess of a 50 reading is expansionary, and anything less than is contractionary manufacturing sector. So we're in the U.S. we've fallen from the low 60s to the low 50s, a 10-point drop, which is a draconian drop. I had an investment committee meeting with Michael and the team at Henry and Horn just last week. In fact, we talked about this specific, very concerning trend. And one of the research houses that we shared with the folks at Henry and Horn did a really great piece on, does this mean that the stock market or the global economy are going to tip into recession? And the long story short there, the answer is no, given or with the assumption that the policymakers, specifically, the PBOC, the Fed, the Bank of England, the ECB, et cetera, respond. And it seems to us, at least, that that's certainly what the cards look like right now. So yes, concerning, given a proper response, but also this is not out of the ordinary, or let's say this is not, it would not be unforeseen or unprecedented to see a 10-point drop in the PMI, but not tip into recession. That happens frequently, as long as there are no other significant imbalances out there in the economy, and we don't really see any significant imbalances right now. And in the cases where the report that we did share with Michael, in the cases where you saw a significant drop in this statistic, and central banks responded accordingly, the financial markets rebound really nicely and continue to perform really nicely as we avert recession. So concerning, yes. Watching closely, yes. Hopeful, yes, still, which is why we're constructive.
So we urge our listeners to tune in to the People's Bank of China. And we need them, stay tuned. We need them to respond aggressively. And, to Joe's point, I think that, the market's expectation is we're going to see a rate cut here very soon. And that is our Federal Reserve doing their part. You would like to think that the worldwide banks are going to go ahead and do theirs. So we're going to see this coordinated, this coordinated global move on the central banks to help push the economies higher globally. So hopefully there'll be a reversal there. So this will be hopefully history repeating itself from the standpoint of central banks doing what they need to do and the market responding positively, which is how we're positioned right now with client portfolios. The thing that we can't control, the thing that we don't know what the outcome is going to be, more so than anything else, in my opinion, is the tariff. And on one hand, we see that Trump really needs this win to continue his air of good feelings in terms of what he is doing proactively and positively for our economy. More so, we feel like the Chinese government and Chinese economy, more importantly, they need a win because their economic growth is as slow as it has been in recorded history, certainly the past number of decades. So with China definitely slowing down, they need a deal. We could use a deal. And yet we still have this tariff talk that concerns me, because you can look and point to exactly when the trade war started. And as soon as it started, we talk about CapEx or capital spending, or what businesses are going ahead and spending money on. And as soon as we announce the trade war, you can see CapEx drop off a cliff. You can see that just completely goes away. So I'd really like to see this reversed. And at the same time, Joe, the bond market also tells us another story. So you got the CapEx on one side that's concerned about the tariffs, and then you've got the bond market on the other side. And to me, the bond market is, again, it's larger in size than the stock market. It tends to be the real institutional, should be the smart money investors. What are they doing? And if you're looking at the bond market, it is on every single announcement, Davos speech, when round one tariffs, round two, when Trump and President Xi have dinner, or around three, every single time there's bad news about the tariffs, you're seeing the bond market get more and more concerned and conservative. So we're seeing tariff talk hurt potential capital spending for businesses. We're seeing the bond market start to get nervous about this potential tariff. So with all of that, Joe, we got to see a deal, right? It's going to happen, because if it doesn't, it to me, it's concerning. What do you think?
Yeah, no, you said it. We absolutely, it is without a question, it is the biggest contributor to, call it, global uncertainty, and probably the biggest risk. I concur, Michael, with you, and probably the biggest risk to global growth. Businesses have a difficult time making decisions on a shifting landscape and an uncertain landscape. Number one, the inflationary effects of tariffs would be extremely concerning as we look to global central banks to cut rates. They're going to have a much more challenging time doing it if, in fact, they're doing it in the face of inflation. So very much a risk. Handicapping it at this point, we're shrugging our shoulders. It's not something that we can get in terms of handicapping POTUS and POTUS decisions on trade on the trade front, the tariff front. I think I went on record with at least a half dozen institutional clients about a year and a half ago saying there's absolutely no way this will ever actually happen.
Okay, well, my fingers are crossed. Yeah, I know it seems to defy conventional wisdom, but I guess we'll have to see. But there's no. Okay, so we'll listen. So here's what I promise my listeners, and here's what we promise our clients is that, and you do the same, Joe, and that to some degree I'm sure, and that is, if there is a change, if we feel like the tariff talks are not going to be resolved, then you'll hear from us, because we will be making some proactive moves. If indeed we say, yep, oh, okay, they're definitely off, we're probably going to have some type of meaningful course change with our portfolio so we can further protect them. Right now, our base clients are not 60-40, we're more actually 40-60 right now. So we have taken some steps to be conservative. We have taken some steps to take some profits off the table. But you'll hear from us, and that brings us to the Fed cutting rates. So, the Fed looks like they're going to cut rates here soon, and so I saw this interesting chart I thought I'd share with you, and it shows the last 4 times the Fed cut rates. 3 of them, the market did not do well, and the one time that it did was in the mid 90s. So the question is, with this rate cut, are we going to get the kind of economic response and market response that we're hoping for? And I think, again, I'm leaning on kind of that global PMI research that we just talked about a couple of minutes ago as Fed doing the right thing and the market responding positively, because it seems like there are a few instances, particularly the last 2 in 2007 and 2001, when the Fed cut and the market didn't respond. But I think that we're probably going to agree that there were a lot of other things going on at the same time.
Yeah. How we're reading rates and Fed policy here, Michael, I'd say the market stands to be very disappointed if the Fed doesn't cooperate. And I think cooperating we define as a 25 basis point cut in July and another 25 basis point cut in September. We don't think that the market will necessarily be poised to rally if they meet that expectation. Mm-hmm. I think the market will be poised to rally if they exceed that expectation and go deeper than that. So I think we're a bit asymmetric in terms of how we're viewing the upside relative to Fed policy looking forward. The historical rate cuts, looking back at the last 5 rate cuts, and we've done a lot of work on the market environment at the time rate cuts were delivered, whether that's, this is not the first time the Fed would be cutting rates, for instance, with the stock market sitting at a record high. That happened, yes, back in the mid 90s. That happened also in 1989. So this is something that happens without question. But I really think that, where we are right here, the Fed has sort of backed itself into a corner, but I think it's a corner they needed to be backed into, and they were backed into by the market. The market essentially decides when rate cuts need to happen, and the Fed decides when rate hikes need to happen. And that's kind of how we read those tea leaves.
Well, we're on the same page there too. So Joe, I do want to quickly point out, because to me this is an outstanding statistic. There's more than now $13 trillion worldwide that has a negative of money that institutions and individual investors alike have put to work, earning a negative rate of interest. That was, as recently as the third quarter of 2018, it was $6 trillion, which sounded like a lot of money earning a negative rate of interest at that time. It's now $13 trillion. this negative rate environment, something that you and I are going to have to continue to keep our finger on the pulse of, because what I don't want to have happen is I don't want the U.S. to go the way of the rest of the developed world in terms of having a negative rate environment, which has a whole lot of other complications. So to me, this is a perfect segue into our special piece for this quarter, which is going to be the economic and political environment from the perspective of the stock market. So what I wanted to do, Joe, just on a real high level, is talk a little bit about the volatility that we're seeing. It's like 6 of the last 7 elections that we've had. There has been the party in power has been removed. And so we're seeing this time and time again. We're seeing that. There was a change in control for the House, the Senate, and/or the White House, 2006, 2008, 2010, 2014, 2016, 2018. It just seems like it's becoming more and more regular, the cycles with which that we're seeing the party in power losing power. Yet at the same time, if you look historically back to everybody going back, this is gonna, you can go back almost 100 years. And if we haven't been in a recession, the odds of getting reelected are really good. But if we are in a recession, the odds of getting reelected are decidedly worse. So if there was a recession 2 years before reelection, like Bush 1, Carter, Ford, Hoover, and Taft, none of them got reelected. The one that did was Coolidge. Again, there's always got to be an exception to the rule, but that certainly doesn't bode well for a Trump administration if they were to see a recession this year. But it seems very unlikely we're going to get a recession this year, and even more so from 1948 to 2017, the third year of a presidential term. We haven't seen a recession in the third year of a presidential term during this very long market cycle. So Joe, here's the question, is that it doesn't seem like we're going to have a recession this year, which would go along with historical standards. But it does feel like we're going to continue along with this cycle of continuing to change which party's in power, as there's this, again, probably the best way to describe it is the wealth gap that we opened up with. And I just wonder, because you and I grew up, and you've been in this longer than I have, and you and I have grown up in this field, and it didn't used to be something we had to pay such close attention to politics when we're crafting portfolio strategy, but it seems like it has evolved differently, and it looks different. What do you think, Joe?
Definitely a lot of wild cards with respect to the financial markets and the current political cycle, no question. And I think that's largely because of some of the outcome aside. I mean, what happens with the presidency, what happens with the Senate, what happens with the House are the 3 big question marks. And still, obviously, Michael, really early on, but we're beginning to see some of the handicaps come in. And, the Senate is likely to retain or be retained by the Republicans. The House is likely to be retained by the Democrats. And the presidency is I think, a bit of a crapshoot. But with the presidency, I think the biggest thing as it pertains to driving client portfolios does sit in the White House in this case. And that's because of some of the economic philosophies, if you call them that, or theories or approaches from the Democratic side of the aisle in particular, are things that we've never seen really here in the United States. And I think everybody on the call probably knows what I'm talking about. These are more socialist oriented. Modern monetary theory is another term that's being bandied about in the political circles, which are things that really haven't been accepted broadly in the United States. I don't know at this point whether this is just pre-election polarization that ultimately will oscillate back toward the middle from a policy perspective, which I think markets certainly would hope. Because if that does not happen, if the policy approaches stay as polarized as they are right now, I think that would definitely be very unsettling for markets as we look forward over the next, really 12 months, because things ought to start to take shape certainly in that time frame. But the outcome of the election is one thing, and as it pertains to investment portfolios, this really right around now, July of 2019, is when we're going to really start taking much closer look at potential outcome of the elections, only because of what kind of policy outcomes may impact financial markets.
Right. And I have had a few clients that have been very clear when they said, if a Democrat wins, I want out of stocks. And we're going to have to cross that bridge when we get to it, but we're going to have to see, because it's not just here in the United States, but you can go to Greece or Switzerland, Italy, Denmark, Spain, you name it, and there is a populist or kind of an outsider new perspective that's gaining ground all across Europe and across a lot of different parts of the world. So it's not just here we're seeing it in the United States, it's everywhere, and it's leading to really interesting times. And I just wanted to do one last political kind of economic factor, and then we'll get to conclusions. And I thought that this chart was interesting. If you look, and if we were to start, let's look at it this way. Right now, our debt to GDP ratio is at 78%. And that's, by the way, debt that's held by U.S. households and U.S. institutions is at 78%. If we want to keep our U.S. debt to GDP at 78%, obviously you could grow the economy, but assuming the economy continues to grow at the rate that it has been growing, and if we're going to need to start cutting our government spending by 1.8% per year starting in 2020. If you start as late as 2025 to do spending cuts so that you can get the debt to GDP at 78%, you got to cut spending by 2.2%. If you wait to 2030, it's 2.7%. So it's something that we at some point have to get this debt in line, in that we do need the government to continue to invest in our economy, but at some point there has to be reason with which that the debt and deficit continue to climb and the spending continues to grow. I don't know what you might want to add. I see you shaking your head yes, but I don't know what it is that you want to add to that. I mean, but we got to do something at some point.
Well, the only thing I'll add is that this used to be a calling card, of the Republican side of the aisle, more of fiscal prudence and the like, which seems to have been abandoned. This year we're on tap. In fact, the CBO just came out last week with the first 9 months of fiscal year 2019 at a $750 billion deficit. So we're on tap to run I believe it's our first $1 trillion deficit as an economy, which takes us up to about $22 trillion of debt. So, it's something that you're not really seeing it almost. I think you and I were speaking the other day. It's almost as if, the Republicans in some senses and the Democrats in some senses, and here in the U.S. are each trying to outpopulate the other. In a lot of ways. So it's a new political dynamic, but in politics aside, our focus is with yours is really just to try to dictate what this means for financial markets. And that's something that is definitely highly on our radar as we look forward in the next 12 months, for sure.
And so our conclusion is that, as we've mentioned throughout the podcast, and that we continue to be constructive on the market, but cautiously so. We are watching the tariff. We are watching the political environment exceptionally closely. We are keenly aware of the market levels, but should the behavior continue to be what we believe it will be, which is the Fed doing what they need to do to push, we get the appropriate push from the central banks across the world. We don't get any new surprises, economically speaking, from the president. If you add up all of those factors, which seems most likely to us, then the market has a path to continue to roll forward in its current direction. Obviously, should we not get any one of those factors, then we would need to recalibrate and then figure out how we were going to adjust client portfolios accordingly. But Joe, how else would you kind of look to wrap up our big conclusion here, our big summary, and what people should be doing besides listening to our podcast religiously?
I would concur. I would concur. I'd call this point in time cautiously constructive. On risk assets in general, those are corporate bonds or high yield bonds or stocks for that matter. And the big contingency here is, and the biggest dictator of financial market returns of those risk assets historically, we think that doesn't change today, is the liquidity backdrop. And that liquidity backdrop right now, if you look at financial conditions, both here in the U.S. and globally, is very, very accommodative, very supportive. Growth across the PMI and other manufacturing indices and service indices that we do look to, we think probably will respond to some more accommodative policies. So that takes us to right back towards that sort of cautiously. And I say the word cautiously only because of these things that you pointed out, Michael. The unforeseen or unpredictable, I guess, whether it's trade policy or some geopolitical event. Obviously, there's things stirring in the Middle East and things of that sort. So there's always those things that prevail or that are looming, I should say, out there. But keeping your nose to the grindstone of what you can at least reasonably handicap, we feel okay.
Right. So be proactive, but don't guess. Please don't guess. You'll never be able to perfectly get all in or get all out of the market. So again, we're happy to take you through it, and we're happy to share with you what we do and how we do it. Joe, you've been amazing as always. We were under 40 minutes, but we were more than 30. So this is something to aspire to. We can't, we're not always going to hit home runs on timing, but I think we did a great job. And thanks to you, you did a wonderful job helping us cover the world economy again. Thank you. Appreciate it.
My pleasure.
With that, I'm going to wrap up our third quarterly market outlook for 2019. If you have any questions, don't hesitate to email us at info@hh-wm.com. Thank you so much and have a great day.
Thanks, everyone. Thanks, Michael.
Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities. Member of FINRA and SIPC.